You know how public companies release those big official reports every year? Well, think of them as the company's report card. But instead of grades for math and science, they use numbers to tell the official story of how they're doing. So let's dive in and figure out how to read that story. If you've ever opened one of these things and just felt completely overwhelmed, you are definitely not alone. It can look like a giant wall of text and tables, like it's written in a totally different language. But what if I told you there's a logic to it all, a code that we can actually crack? Because at their core, that's all financial statements really are. They're the end product of all the company's accounting, and they're basically a formal communication channel between the people running the company and, well, everyone else, investors, the government, you name it. They are the official story. To start reading that story, we've got to begin with one of the most important documents, the balance sheet. And the absolute best way to think about it is as a snapshot, a single photograph of the company's financial health on one specific day. Okay, so what you're looking at here is how they're set up for companies in India. It's got two main sides, and here's the magic trick. They must always, always balance out. On one side, you've got equity and liabilities. This is the source. It tells us where all the money came from. On the other side, you've got assets, and this is the use. It tells us what the company did with all that money. So this brings us to the golden rule, the one simple but super powerful equation you need to remember. Assets equals liabilities plus equity. Everything a company owns, its assets, has to be paid for with money it either borrowed, those are the liabilities, or with money from its owners, and that's the equity. This is like the law of gravity for accounting. It always balances, no exceptions. All right, now let's break this snapshot down into its basic parts. We're going to look at what the company owns versus what it owes. But to really get it, we first need to learn a little bit of the language that accountants use. The first big distinction you'll see everywhere is current versus non-current. The rule of thumb is simple, 12 months. Current items are things the company expects to use up, sell, or pay off within about a year, like their inventory or their short-term bills. Non-current items are all the long-term things, like buildings, big machinery, and loans that aren't due for a good long while. So if we look at the O's side of the equation, it's broken down pretty logically. Right at the top, you have the shareholders' funds. This is the money that actually belongs to the owners of the company. Then you have the liabilities, which is what's owed to everybody else. And these are split into non-current for the long-term debts and current for the bills that have to be paid pretty soon. And over on the own side, we see the exact same logic. Non-current assets are the long-term heavy hitters of the company. We're talking factories, patents, big equipment. Then you have the current assets, the things that keep the business chugging along day to day, inventory on the shelves, cash in the bank, and money that customers still owe them. Now, understanding these categories is step one, but here's the real secret. Step two is realizing what these numbers are really made of. Okay, so we get the structure now, but this is where things get really, really interesting. You might look at all these numbers and think they are pure objective facts, but they're not. They are actually the result of a whole set of rules, principles, and even personal judgments. This quote just says it all, doesn't it? Financial statements aren't just about what happened, it's about how what happened gets recorded. There's a human element baked right into the numbers. So let's break down exactly what that means. We can think of these statements as being built on four key pillars. It all starts with recorded facts, then you add a layer of accounting conventions, which are kind of like the common rules of the road. On top of that, you have basic assumptions or postulates. And finally, you have personal human judgments. Let's take a quick look at each one. First up, the facts. When a company buys a building, it gets recorded at the price they paid for it, the historical cost. Now, that number on the books doesn't change, even if that building's market value has totally skyrocketed. So the balance sheet isn't showing what the assets are worth today, it's showing what they cost. This means a sharp investor might be able to spot some hidden value that isn't obvious at first glance. Next, we have conventions. These are just the accepted ways that accountants do things to keep everything consistent. A classic example is how they value inventory. The rule says you have to record it at either what you paid for it or what it's worth today, whichever amount is lower. This is a conservative approach, a little safeguard to keep companies from overstating how much their stuff is worth. The third pillar is postulates, and these are really just fundamental assumptions. The most important one is the going concern concept. Basically, accountants just assume the business isn't going bankrupt tomorrow. And because of that assumption, they can spread the cost of a giant machine over its entire useful life, instead of taking the hit all at once. It's the bedrock that makes long-term planning even possible. And finally, we have personal judgments. How long will that new machine really last? 5 years? 10? An accountant has to make an estimate, a professional, educated guess, but a guess nonetheless. And that judgment directly affects the company's profit. This is an area where there's a little bit of wiggle room, and it's something that smart analysts always watch very closely. So why do we go through all this trouble? Why do all these rules and judgments matter so much? Well, because these statements are used to make some incredibly important real-world decisions. Just think about who's using this information. You've got investors trying to decide whether to buy a stock. You have banks using it to decide whether or not to lend the company money. Heck, you might even use it when you're thinking about a job offer. Everybody is trying to figure out the same things. How healthy is this company? Can it make money? And is the management team doing a good job? See, financial statements aren't just a boring collection of numbers. They're a narrative, a story that's built on facts, conventions, assumptions, and human judgments. So the next time you open an annual report, you won't just see numbers anymore. You'll see the building blocks of a story. The only question is, what will you be looking for?